And that's kind of a challenging question in lots of ways. But maybe one way we can address that is to speak to what is the demand in the marketplace on any given day. Either demand for bonds that we have wanted to buy and have missed, maybe due to price, or more broadly, what's happening in the corporate or structured parts of the marketplace where we can see on a certainly weekly basis the amount of demand for bonds that are being issued, in structured securities that are being issued. We have really good lenses into how much capital is being have an interest in a particular new issue, and that's something people can pull up publicly, even via like Bloomberg terminals, et cetera. Certainly the corporate bond market. So from a well-functioning bond market perspective, at least from a demand perspective, it's functioning really well in 2025, and has that there's been this pretty large technically driven aspect to the marketplace as there's been more demand than bonds. And so how does a market function in that environment? It reprices the spread lower. Maybe a company issues a few more bonds. But at this point, whether it's in small odd lot sort of activity that we might participate in other areas, to very large blocks, we see healthy bid, certainly bid side market environment. And again, on the offered side, sometimes as we're trying to buy bonds, we miss because our prices aren't competitive enough. So that'd be one way to determine if markets are functioning properly. I think when they're not, it's when you might want to explore the depth of a bid of a particular security, and nobody even wants to raise their hand. And we haven't seen that since probably to any meaningful extent since the first quarter of 2020. Is there anything you want to add to that?
No, I would maybe just given the market which we're in, which is very tight spreads, we're in a tranquil market. I would just slightly tweak the question to what are the main indicators to watch to whether the credit markets are how overheated they are, and that's a much easier thing to talk about today. Supply demand is out of whack. There is just so much demand for fixed income inflows, increased insurance allocations, switch of allocations from public toward private assets, particularly in securitized and in private credit. So we're seeing oversubscription levels, very, very high oversubscription levels. So therefore, you're seeing tighter pricing, you're seeing weaker documentation, you're starting to see weaker collateral trends. It's a borrower's market, and secondary markets are trading tighter than primary. The depth of bid, the number of dealers bidding is robust as we've seen, particularly in like CLOs. So all signs point toward just a lot of demand, and therefore people have to put money to work. So that's an environment where we're just going to be more cautious. Areas we've stepped back completely from certain areas of the market due to any combination of spreads or collateral or documentation. And so this is a market to be vigilant and not get out over your skis by any stretch.